Welcome to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
And he said, you can keep your change and I'll keep my dollars. Well, three things in life are certain, right? Death, taxes, and change. Here we are. Happy New Year, everybody. Happy New Year 2026. And with the new year comes hope of change, right? Change for the better. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about resolutions. And I think, AAA, you talked about going to the gym every day in 2026. Is that you're having all the radio listeners keep you accountable?
I didn't say that. Maybe I should, but I didn't.
Out with the old and in with the new. Yeah, that's just a little joke there.
Well, I like everybody else, I'm getting my mind around the fitness changes for 2026 and how I'm going to do that and, that kind of thing, right? It starts with an idea and then you have to move into, the practicality of how are you actually going to make that happen and change the behavior. Behavioral change is a real funny thing, right? And we have to reward ourselves often in order to get that change. But, today, Daniel, it's a new year. Happy New Year. And I'm really excited about today's show. I'm excited about this new year. Like I was telling somebody recently, we're going to be making a lot of changes in 2026. I don't even know what all those changes are right now. I just know we're going to be making changes. And once I get my head around the change, I try to embrace change because three things in life are certain: death, taxes, and change. And the big question about change is, how are you going to deal with change? Are you going to embrace it, or are you going to shrug it off? Are you going to push it away, right? Just like that equation I love so much, E plus R equals O. An event plus your response to that event equals the outcome. Now, you can't change the event that happens to you, but you can change your response, which changes and dictates the outcome. But if you make the wrong response, guess what? You start over again. Now the outcome is a new event, and you go back to, you have to have a response to that event. And, if you keep making the wrong responses, it will, just spiral downhill and out of control. But that's where, as we have been given just wonderful brain and all these things that God gives us, this computer within our physical body that God gives us, we are able to change. We are able to dictate a lot of things that we do in the future. And that's what this show is about. Resolutions, right? 2026, resolutions for 2026. Out with the old, in with the new. And pretty excited about that because there's a lot of things that we can be shedding these days, especially people in and close to retirement, and should be shedding. That we talk to people about every day. And if you're one of our regular listeners, you're going to recognize a lot of this stuff. But we wanted to boil it all down, consolidate it into one place so that people can actually have a methodology by which they can change for the better in 2026.
Yeah, so resolutions are really broken down into two things, right? First, you need to see clearly. You take something complex and you break it down into smaller pieces. That's what, if anybody's had a research paper, if somebody's ever had something that they don't know how to do in work, or somebody's trying to start a new incentive, is you have to break it down into manageable size pieces. Break it down into things you know how to do. And that's really the only way your brain is able to move forward. AAA, you keep talking about change. Well, you have to want to change before you can change, right? That is a thing. And that's where the resolution comes in, is you have to want change. You have to make an effort. So you start with that resolution, seeing things clearly. A change needs to happen, right? What is lacking, or what do I want better, right? You've said many times, people typically go towards something, towards pleasure, or away from pain. And that's where the resolution comes in, is because you're going away from pain, or you want to go towards something better than what you have, right? Exactly. The second is deciding firmly, right? You have to choose that you want something different. So the first is seeing things clearly, and then making that decision. And that's something you've talked about and taught me about. You're always making decisions, AAA. People are always making decisions.
Yep.
Now, sometimes they make the decision by accident, or they make it by not making a decision, and they give themselves a pass.
Indecision by indecision.
Yeah.
Right.
It happens all the time.
Yeah.
It feels easier, but it tends to take the control out of your hand and let whatever will be, which is not what we're talking about, because that's not seeing things clearly, and that's not deciding firmly. So we want to go away from decision by indecision, because that's not setting people up for success. And we believe in retirements that are made by decision, because we want our clients to have retirements that are set up for success, not happenstance. Right, AAA?
Right. Yeah, you got it, man. And that is huge, right? Because there's so much around the decision-making process that we could have a show just on that, right? But I just want to say that one thing I learned many years ago, the quicker you make a decision, means the quicker that if it's the wrong decision, you can course correct and get on the right course with it. But the longer you delay it, just kicks the can down the road and doesn't help anybody from that standpoint. So, I'm a firm believer in proactivity as opposed to reactivity. And unfortunately, I think the world has a lot more reactive people than proactive people. But, nevertheless, you can still work with that, right? So you listen to Financial Strategies with Andrew and Daniel Agemy. This father-son team coming to you today to help you, to inform you of what you don't know that you don't know, so that you can make a smart decision on purpose. And today's show is Resolutions 2026, out with the old, in with the new. Happy New Year! And listen, we have something for you today that we were always liking to give things away. And today, one of the things that we have right at this moment to give to you is a white paper that we put together for the show. Because one of the things when people think about a new year, at least as they approach retirement or in retirement, is wondering about their money, and have they saved enough for retirement? How is this year going to be? What's am I going to run out of, even if they're in retirement, am I going to run out of money? All those kinds of things. And we have a paper that will help you to look at and think about the things that you need to be thinking about, so that you can make sure that you are able to retire. If 2026 is the year for you to retire, that you want to retire, and you listen to us with our education, you'll be able to move forward with that. That'd be a great present, right? To resolve to retire in 2026. So this paper will help you. Have I saved enough to retire? Ask for it by name for calling 800-725-7616, 800-725-7616 for your free copy. Call now. You listen to Financial Strategies, this father-son team coming to you to be able to help you know what you don't know. Today's topic, Resolutions 2026, out with the old, in with the new. Boy, Daniel, so, talking about seeing things clearly, making the decision, and that's where determination comes in. You can't have determination without some kind of desire, without wanting to do something, right? And if you want it bad enough, you can make a determination that you're going to go after it and get it. And that is really the key behind resolutions. And so many people don't keep with their New Year resolutions because long and short of it is they don't want it bad enough.
Yeah, that's where that why comes in, right? Everything has a why behind it. Why are you making that resolution? Is it because your health is poor? Is it because you're tired of insanity, doing the same thing over and over and expecting a different result? Is it because you're fed up with your boss and you want to retire? Is it because you want to start new hobbies and that looks so fun to go do something new, right? Figure out the why, and then you can make that resolution to get there. And the power of that why is so important.
Yeah. So out with the old, in with the new. And especially it's important for people who are approaching retirement or ready to retire or in retirement. And because retirement is a different mindset. It's a different thing altogether than what people have been used to. Ideally, a person retires one time. They only go back to work because they want to go back to work, not because they have to go back to work. Like in 2008, during the financial crisis, people either couldn't retire or had to go back to work, many people, because they didn't do things the proper way, to their greatest fear. And so that's what we're trying to trying to bring out today is that as you approach retirement, you have to do things differently than you did yesteryear. You know, in your 20s and 30s, you can do things physically that, you know, in your 60s and 70s, you can't do that same way. If you're running in your 20s and 30s and you're running in your 60s and 70s, well, it doesn't look the same in your 60s and 70s as it did when you were in your 20s and 30s. So things change. And, you know, the thing that as you well know, Daniel, I like to say is that, you know, we retire every day vicariously through our clients. So we know what it's like to be 50 years old and retired, 60 years old and retired, 70 years old and retired, et cetera, et cetera. And so we know about things that people who have not gotten there yet know, and we can help guide them through every step of the way.
Yeah, AAA, there's getting rid of the old, out with the old. And out with the old means most people have been taught for 30, 40 years, some less, but basically by the time you're about 5 to 10 years out of retirement, you have been ingrained, you have been taught, and it has been forced upon you that you need to take your dollars out of your paycheck and throw it into the stock market, throw it into your whatever type of fund, your S&P fund, your bond fund, your equity fund, or our favorite, your target date fund, right?
Right. Or your 401k, you know, I mean, and I know those things can be in 401ks, but some people in our audience don't see those as a separate thing. So I want to say, wherever it is, right? Your 401k or these separate funds. Yeah.
Yeah.
Go.
And get rid of the old, because that has served people for a period of their life. But as you transition, as you said, AAA, except for Tom Brady, right? Except for Tom Brady, as we get older, typically we're not as fast and we're not as athletic and we're not as good as doing things. Same with the way your investment style goes, is as you get closer and closer to that retirement, you have more money, which means it needs to be invested differently. People just think it's about packing money away. But at some point, you have enough money where your money can work for you. It's not trying to grow your money as much as it's now your money can actually pay you. So you need to protect it, because if it's not there, it can't pay you. Right. Whereas if it's $5,000, it's not paying you anything anyways. So what if it goes up or down? You're just hoping for increase. But now if we're talking 500,000, 5 million, and it goes down, that is a big deal, because now if it goes down 50%, you have 250, you don't have 500, and 250 can't pay you anything like 500 can pay you. So why would you try to go from 500 to a million if you can live off of 500? That's winning the lottery, right? When you get to the spot that your assets can pay you enough that you need to support the lifestyle that you want to have.
Exactly. Oh, man, this is good stuff. You listen to Financial Strategies. Andrew Daniel Agemy. Today's topic is Resolutions 2026. Happy New Year. Out with the old, in with the new. And we hope you had a great Christmas, great New Year's, and expect that 2026 will be even brighter and better. And to go along with today's show, we have a video book. This is a 3-track animated video book that has short 2, 3, 4 minute videos, animated videos expressing some kind of thought process, strategy, education about retirement that we would love to put in your hand in this new year for free by calling us at 800-725-7616. The next 5 first-time callers, this is a $75 item, 800-725-7616 for free for you. For the next 5 first-time callers, call now.
Time for some tough questions for these financial advisors. What makes retirement income source different from other financial?
Our extensive experience generating investment income quickly so you can have financial peace of mind, navigate your retirement smoothly, and have more time to spend with family and doing the things you love. Honey. We gotta talk to these guys. We're done here.
You're locked on to Financial Strategy with Andrew and Daniel Agemy.
So you and our listening audience, if you know a 20-year-old, 30-year-old, maybe even a 40-year-old, ask them about what retirement looks like to them. And then think in your mind and compare in your mind how that compares to your definition of retirement. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. And today we're talking about out with the old and in with the new. And AAA, that old is accumulation thinking. Do you want to break that down for us?
Yeah, well, the idea there is, when you're young, you're 20, you're 30, you're 40, whatever, you're just trying to save money, accumulate money. And you want to see it go up, and that's the whole mentality. But one of the things that happens is you kind of get stuck in that rut of watching the money go up. And if you're saving in a 401k, we call that 401k brain, right? Accumulating money, watching it go up. And, where you put your money in, it can also be called capital appreciation, meaning that, you put your money in like an S&P 500 fund or something, and, it goes from $100 a share to 110. And in that case, you just made a 10% capital appreciation growth on that investment. But it's totally different when you're younger than when you're in or close to retirement. And that's what we're talking about today on Financial Strategies. Resolutions 2026, out with the old, in with the new. That's the old way of thinking, but as you approach retirement, you have to have a new way of looking at that.
Yeah, AAA, another way to say that would be, because I think most people listening want to see their money accumulate. They want to see their money grow. But another way to look at that would be like packing money away for capital appreciation is like taking the elevator up. It's really fast, it's fun, but if you push the wrong button, you're going to be in the basement and you have no control. You have no idea where you are. If somebody else pushes the button, if you push the button, it might take you up, it might take you down. You don't know exactly what's happening. Usually it works pretty good, but not necessarily you want to be depending if you have to get up there with no stops along the way. Whereas if you take the escalator, it's steps and it's elevating you, right? And that's kind of like once you build up your assets, you take the escalator where it can carry you up, but you're ratcheting in as you go along. It's stepping, it's stacking earnings. Because when the income comes in and you're not spending it or you're not using it to support your lifestyle, it's stacking. Earnings stack on earnings and it still grows. But it's a more certain way, just like the escalator. You have the steps where you can stack and you can climb, or you could just sit there and let it carry you up. But you can see what's going on around you while it's happening.
Exactly, Daniel. That's a great illustration and analogy using the elevator, because how many times, probably most people, listening to us, you and me as well, have you ever stood at the elevator door, it opens up, you get on, and the button is pushed to go down? When you're wanting to go up, right? Somebody else pushed it. You had no control over that. And what do you have to do? You either have to stay there and wait for it to go down, come back up, or you could write it down and write it back up, right? And that's what most people do with their portfolios, right? They have no control. And when they go down, like 2008, they had to wait until they came back. And people who were 50 years old in 2008 don't have that time today because they're 65 years old today. And they don't have that time to wait for that elevator. So that's where you take the escalator.
Yeah.
Because
a lot of waiting, right? Waiting for the doors to open, waiting for the doors to close, waiting for the people to get in, waiting for the people to get out. And then just fast, up and down, a lot of waiting. Whereas the escalator, it's consistent.
Yeah.
That's really what we're talking about.
And with people, I'm kind of visual. I'm more on the visual side of things, and I can see things in my head, even though you can't. I can look at an old car, and I can see what that could look like transformed after it's rebuilt, or different things like that, right? Or right, different things, but not everybody can picture things like that. And that's what's great about the escalator. Because on the elevator, you have to trust when you get on, it's going to go up and that it's going to take you where you want it to take you. But for whatever reason, you don't know. And it's blind faith. It's blind faith. It takes more faith to get on the elevator than it does to believe in that there's a God. But with the escalator, you can see the top. and you can see where you're going, and you can see, hey, I'm going to make progress no matter what. Two different views, right? Get out of the elevator mindset into the escalator mindset. Is out with the old, in with the new. When you're young, when I was young, I remember being 13 years old, and I went to a convention, and my friends and we spent all day at this convention riding the elevator up and down. And I had one friend who was claustrophobic, and one time it got stuck, and we were laughing at him because he was scared because it was all right. But we were young. We had a great time, up and down, up and down, up and down, all day long. But am I going to do that today? No way, right? You do things differently when you're older than you do when you were younger, right? It's kind of like anybody in our listening audience have maybe a 25-year-old son or daughter. You think that 25-year-old son or daughter is going to come to you and say, hey, Dad, hey, Mom, I want to go back to my pediatrician for my doctor. No way. They're adults now. They're grown men, grown women. They're going to want a regular doctor now, right? General practitioner, not a pediatrician, right? Why? Because pediatricians do things differently than adult doctors and than general practitioners. And because they are now adults, they have to be looked at differently. And the same thing with retirement portfolios and retirement planning. You're listening to Financial Strategies with Andrew and Daniel Agemy. Happy New Year 2026. Resolutions 2026. Out with the old, in with the new is our topic today. And we have a book that we love to give you today for listening. This book we haven't given this book out for a while, but I love this book. It's called Smart Retirement. Simple, right? Smart Retirement. This is a book that is an easy read book that will help you to be able to look at life with a different perspective. Look at retirement planning with a different perspective. And this is not just for people who are 50 years old plus with $500,000 to invest with us. This is for even younger people if you want. So for the next 5 first-time callers, call to get your copy of no obligation, Smart Retirement. It's a $55 book, giving it to you for free. First 5 first-time callers, 800-725-7616 for your free copy. 800-725-7616 for your free copy of Smart Retirement. You're listening to Financial Strategies with Andrew Daniel Agemy, because people don't know what people don't know. Daniel, we've been talking about these resolutions and, the determination of working towards something in 2026 that's better, changing for the better. And, getting rid of, in order to do that, you got to get rid of those old patterns, those old thoughts, those old way of thinking things, and move into the new way of thinking things. And many times, what you and I both find when we talk to people in and close to retirement, whether they're radio show listeners or whatever, is that sometimes people have those new thoughts, but a lot of times they still think in the old way. And we have to help them get their head around how it's going to be in retirement as opposed to how it is now.
Yeah, AAA. Some of those old thoughts, right, are old 401ks, old companies, old funds, old investment advisors, right? Those are things people have to examine, right? We focused on the growth versus accumulation mindset, right? That's another thing that's out with the old. The crystal ball investing, right? We've talked about that a few times.
Right.
And that's probably the biggest challenge with capital appreciation investing is you can get growth two ways. We talked about the growth through organically reinvesting the dividends. But the crystal ball investing is, when do you take your profits? Because there's been plenty of times where people ride up. They need a crystal ball to know when to sell, right? And they sell too late, they sell too early, you remove that. So that's another thing. The crystal ball investing, out with the old. And then mismatch between your terminology and the financial world, the financial advisor's terminology of what growth is, of what conservative is, things like that. Right, AAA?
Exactly. And, Daniel, along with that comes, many times we'll have somebody in or close to retirement and they'll say something like, I want to ask my son about this, who's maybe 50 years old. And I say, okay, that's great. But, really your son doesn't know what's going on with this, with all respect. Your son hasn't experienced this yet. Many times people get experience from their own time frame, from their own experience, as opposed to learning from the experience of other people as cheaply as they could get it. And so that's what we want to offer people. That's why we have the show so that we can do it. And there's a lot of things. Daniel, you asked me earlier, what about the accumulation mindset? And what I forgot to say in that, Daniel, was everybody wants to accumulate. Like you said, everybody wants to see their money grow. That's a given. Nobody wants to see their money stagnant and not grow. But the question is, that's not the question. I'm coming from a presupposition of growth is a given. The question is, how are you going to receive it? You're going to receive it by getting on the elevator, and maybe you go down before you go up, or are you going to get it by going on the escalator where it just ratchets up? And that's the concept of the distribution or the income mindset that people, about 5-10 years before retirement, people need to start looking more at, switching to more of a distribution, a little bit more conservative mindset. Still going after growth. We still want growth, but we want consistency in growth rather than the roller coaster growth. When we talk about the new year, resolutions 2026, out with the old, in with the new, one of the things that goes along with that is 401ks. And we talked about that very briefly, but I want to talk about that more in a minute. However, before that, what I want to say to you and our radio audience is you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is Resolutions 2026, out with the old, in with the new. Happy New Year! And so we have, so many times people are wondering, can I retire? When can I retire? Is 2026 going to be the year I retire? Well, so many times people also will say, I don't have enough to retire. I only have $1 million. I only have $2 million. I only have $3 million, whatever the case may be. And it's not how much money you have that makes a difference. It's what you can do with the money. It's not about what you make. It's about how much you get to keep and how much you get to have as a paycheck. So we have put together a little conversation where we call the Retirement Readiness Report conversation, where we can tell you about how we have an analysis that we can do to help you understand if 2026 is going to be the year or not. And we love to be able to have that conversation with you in our listening audience. And please call 800-725-7616. Ask for the RRR conversation, 800-725-7616 for your free conversation, 10-minute conversation with me. 800-725-7616 for the next 5 first-time callers. Call now.
Do you have any questions for me about retirement income source?
I just want to make sure I can invest well enough to have enough income, enjoy my retirement.
We build a custom retirement plan based around your income and goals.
How do I know I can trust you?
Building trust does take time, but our investment advisory arm is comprised of fiduciaries, which means our obligation is to you. So you can enjoy your retirement with a little more income stability.
I'm in.
That's 2 out of 3.
This is Financial Strategies with Andrew and Daniel Agemy.
AAA, a young man came to his advisor and said, "How did you get to where you are?" And the advisor thought for a second and he said, 2 words, good decisions. And the young man thought and he said, "How do you make good decisions?" And the advisor said, 1 word, experience. And the young man thought for a second and he said, "How do you get experience?" And the advisor said, 2 words, bad decisions. I'm Daniel Agemy.
And I'm Andrew Agemy. You're listening to Financial Strategies with Andrew and Daniel Agemy. This Father Son team coming with our topic today, Resolutions 2026, out with the old, in with the new. And we're talking about why Daniel is talking about bad decisions, good decisions is one of the aspects of out with the old, in with the new is making decisions that are going to help you, that are decisions on purpose rather than by indecision, decisions to go toward that which is good, which is new, which is going to help you to make progress and to be able to retire versus decisions by indecision and the wrong decisions. But even if the wrong decisions, there's still value. So Daniel, that's a great, you saw me laughing and enjoying that because I kind of knew what was coming with that. And that was a great way, I think, of starting this when we're talking about resolutions today.
We're talking about out with the old and in with the new, AAA. And
right.
A lot of people have got through the bad decision-making process. That's what we're saying. Get rid of that. And now it's time to bring in the new, right? Use that experience. You know what worked in the past is probably not going to get you to where you need to go. Get rid of the old. You already made your mistakes. Now it's time to bring in the new. 2026 is to bring in the new.
That's right. That's right. And that's exciting, right? When we're thinking about how things can change for the better, how there can be new things, right? Who doesn't like a brand new car versus a old car, right? You know, that new smell and everything like that. So new can be good. And ideally, you know, like we talked about, you know, it's up to many of us on whether that's going to be good or not. And, you know, one of the things that I find lately, what people are not doing away with the old is old 401k plans. You know, I come across people that have maybe 2, 3, 4 old 401k plans of companies they used to work. And it's egregious in my mind because those plans are just going up and down with the market. They're not putting any money in, so they're not growing from new contributions. They're not growing from dollar cost averaging. They're just going up and down with the market, and they're not working very well. They're only working from a capital appreciation standpoint as opposed to a capital appreciation and income standpoint, which, you know, in my mind, that's the better way to go. But people have these old 401ks. They have this mindset. And one of the things they need to do away with is those old 401ks. Well, why? Because number one, you roll over your old 401k into an IRA, and now you can invest in anything. I mean, sure, your 401k plan might have a bunch of different options to invest in, but it's not all the options that you can invest in. When you put it in an IRA, you now open yourself up to all the investment options out there for the most part. Certainly a myriad more of options than your 401k plan has. So that's one option. Number two is it helps the next generation to move on to the next generation easier than a 401k plan. But one of the bigger ones, bigger one would be, you know, a lot of times these 401k plans are small and maybe they got $10,000 in it. And $10,000, if you make 10% on $10,000, that's $1,000. Not a lot of dollars, not a lot of money. But if you roll that over into a plan, if you had 3 $10,000 plans, 5 $10,000 plans, roll it over into an IRA, now you got $50,000. And if that goes up 10%, well, what do you have? You have $50,000 growth. You have $550,000 now. It feels a lot better emotionally at that point than little ones do. And so consolidation is a thing to be considering as you out with the old, in with the new.
Yeah, AAA, the compounding effect works better as well. It's less mental, it's less taxing, it's less mental taxing. And compounding, money loves to compound on money. So if you had 10 accounts, it doesn't compound in the same way, even though it's the same amount of money, as if those 10 accounts were consolidated into one larger account. And that's one of the magical things about compounding interest. And when we're talking about compounding interest, we're literally talking about compounding interest where the growth is making babies, which is making babies, which is making babies, right? Or the chickens are turning into more chickens, which are making eggs, which are turning into chickens, which are making eggs, which are turning into chickens, right? That's the compounding. Whereas when people are buying funds in their 401ks or stocks in their 401ks, whatever they may be buying, they're hoping that the companies are compounding, but they don't know because nobody's doing the individual research on the companies inside of the fund. They're hoping, everyone's hoping somebody else is doing that, but is anybody actually checking to see if those companies they're owning are compounding? And if the companies are compounding, then the stock should go up. But if the companies are not compounding, it's just a hope thing. And that's where people get mixed up with the terminology of compounding is when you have the assets coming into the account and then you're buying more with that, and then it's producing more, so then you can buy more, so it produces more. And when you're looking for capital appreciation, there's no compounding going on unless the company is compounding, but most people have no idea if that company is or not. It completely changes. Out with the old way of hope and in with the new, right, AAA?
Exactly, Daniel. And that goes right to a paper that we have for our listening audience today, Daniel, that will help them understand what you're saying. And, by reading it, by watching it, especially for those people who are visual, they'll be able to look at it on the page and understand what you're saying. It's called The Truth About Growing Your Money for Retirement. The Truth About Growing Your Money for Retirement. And we love to put that in your hand by calling us at 800-725-7616. No obligation, free of charge. The Truth About Growing Your Money for Retirement. Get it by calling us at 800-725-7616. I'd love to put this in your hand to help you be able to make smart, wise, knowledgeable decisions toward your retirement. You're listening to Financial Strategies with Andrew Daniel Agemy. Today's topic is Resolutions 2026. Out with the old, in with the new.
AAA, as we move forward here, in with the new. What are we talking about with in with the new? I think people need to start with, what type of investor are you? We're talking to people who are 5, 10 years pre-retirement, or people who are already in retirement. A lot has changed. That's the new for you, right? Is thinking about retirement, starting retirement. And the first question investors and retirees have to ask themselves are, what type of investor are you? You might not like that question because you might not want to think about it, but it's important as you move into retirement to ask that question.
It definitely is. And it's also what the type of investor you are is going to be dependent kind of somewhat on how much money you have. And, when we're talking to people, we're talking about the strategies that we're employing for people are with a few $100,000, if not $500,000 plus, because not that saying there's still things that can be done for those people with lesser in certain situations, but it's two different things. And so many times people don't understand what kind of investor they are. They don't think about it. I mean, they might say, if you say, are you conservative or invest or aggressive at this point in your life, they might say one or the other, or they might say moderate. But typically, when I'm talking to people and trying to help understand what their definitions of their investment perspective is, they don't really have any idea unless I help them put words to that definition. And that's huge. Understanding what kind of investor you are, because it also dictates what kind of person should be investing your money for you. Should you be doing it yourself, investing your money yourself? Should you be getting an advisor? Should you have an income specialist advisor? What kind of person should be having? It's kind of like assessing what kind of leak do you have in your plumbing at your house. Is this just a simple leak that the carpenter can come and finish, the handyman can do? Or is this a major one that you have to call in the plumber, who's the specialist, who has not only the better tools in his toolbox, but also the better experience to fix the leak?
Yeah, AAA. So when we ask people what type of investors they are, there's usually a few answers, right? Are you aggressive or conservative? And people usually can answer that. Okay. Are you aggressive or conservative? And the other one is, are you a speculator? This is the one that typically catches people up, because a lot of times financial world and you as a retiree or investor have different definitions. Are you a speculator or you are an investor? And our clients tend to be moderate to conservative and investors for sure. But what ends up happening a lot of times, AAA, is people will say that they're conservative and that they are investors. but their financial professionals or the people they listen to on TV or wherever they're getting their information from is a speculator and putting them in speculation, but calling it investor. And that's really what people need to pay attention to as we talk about out with the old and in with the new. You need to answer these questions. Are you aggressive at this stage of your life or conservative? Or where on that spectrum are you, aggressive to conservative? And are you a speculator, meaning you're going for hope and that elevator mentality? Or are you an investor where you want to see compounding, you want to see stacking returns, and you want to protect what you've already created, right, AAA?
Yeah. And one of the things going along with it, you basically said it in there, Daniel, but I'm just going to articulate it a little bit differently, which, conservative, in my mind, most people in and close to retirement, they always still want their money to grow if they're conservative. But the key to the definition of conservative is not losing principal. Most retirees, pre-retirees agree, like that definition, not losing principal, but making as much money as you can. You listen to Financial Strategies with Daniel Agemy. Today's topic is Resolutions 2026. Happy New Year. Out with the old, in with the new. And this father-son team coming to you today. And we love to be able to give you something go along with today's show that will help you, with the holidays, Christmas, New Year's, family gatherings, and thoughts of the new year and what you want to do differently in the new year. Come many times, people asking and looking at questions, having conversation with their families, their children, adult children and whatnot, about what things should be like, what things look like. I know I'm thinking about it, having these conversations with my family. And today we have a legacy planning checklist. The amount of time, money, and effort that you put into preparing your legacy now is nothing compared to the time, money, and effort that those after you will have to put forth. And unfortunately, the money they spend will be your money. So it's better that you do it than leaving it to somebody else to do their planning. This is called Legacy Planning Checklist. And this checklist will help you ask the right questions to your family, to yourself, to your spouse, and help you to be able to be better prepared and be able to make smart, wise decisions, because you don't know what you don't know, and this will help you know. Call and ask for it by name. Legacy Checklist, 800-725-7616 for your free copy, 800-725-7616 for your free copy of the Legacy Planning Checklist. Call now.
You're locked on to Financial Strategies with Andrew and Daniel Agemy.
I have had many conversations with people that I meet about their view of an investor, be able to understand them. And when I ask people, are you aggressive or conservative investor? Many times people in and close to retirement will say, I'm conservative at this point in my life. And then I say, well, do you agree that conservative is as much money as you can without losing principal? And they say, yeah, that's my definition of conservative. And then I look at their portfolio, I do a financial MRI in their portfolio, and I say, okay, well, how much money do you think you should have at risk in the market, stock market, versus all the universe of other options that are available? And they'll say, oh, maybe 10%. And I look at their portfolio and I find that there's just the opposite. 90% is in the market, 10% is conservative. And they say, how in the world did that happen? My financial advisor knows I want to be conservative. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about resolute on retirement and AAA resolutions as we go into the new year. I hope that a lot of people are making that resolution that this is going to be the year that they're retiring. This is the year they're going to start enjoying, or that they're making a resolution to start getting ready, to start getting serious, and make decisions on purpose about retirement.
Right. That's a very important thing, Daniel. And it's very important to make sure that people know what kind of investor they are. And, when you say that, Daniel, this is what comes to my mind. I had a phone call. I have a friend who calls me every December and wishes me Merry Christmas. And he didn't call last year. And he didn't call this year. So I called him. And I say, you don't sound normal. What, is everything going on? He said, I have 4th stage cancer. It's all over his body, in his bones, all these kinds of things. Now, he knows where he's going to be when he dies, and I'm going to call him a lucky stiff because he's going to make it to heaven before I do. And we know he's going there. But the point is, he has just retired. He said, I'm retired now. Well, when I talked to him 2 years ago, he wasn't retired. And so he hasn't spent much time in retirement. So when I think of your grandfather died 10 years after he retired, he spent 10 years in retirement so that he could do what he wanted to do in retirement. And I hope that this is the year, because we never know. We're going to be like my friend who contracts cancer and doesn't have much time, or we're going to have 10 years in retirement, or we're going to have 20, 30, 40 years in retirement, because some people are having that much time in retirement. And so it's important to be able to have a resolution of understanding, taking control of your retirement and of your assets so that your money doesn't manage itself.
Yeah, AAA, there's definitely some important decisions that people have to make. And it makes me think of what you had said earlier when you're giving that paper away regarding estate planning. And with the estate planning, there is a plan for you. It's just the plan you put together or the plan that the state is going to put together for you, because they have a plan for where your assets are going to go. And, most people don't really want some person, in the state, in the town, in the whatever, making decisions where all their hard-earned money goes. So that's why it is so important to make these decisions on purpose and to make retirement decisions on purpose.
Right.
So what kind of investor are you? Are you aggressive or are you conservative? Are you a speculator or are you an investor? Ask yourselves those questions and then ask yourself, is your retirement portfolio set up in the way you just asked those questions? AAA, the retirement risk report that we've talked about so many times is basically a tool for an objective second opinion. Because what it does is it shows fees. A lot of people don't understand that they pay a fee for financial advice, and then there's an internal fee for the people who are actually managing the money. And the person giving the advice is buying these funds that somebody's managing the money in those funds. And so there's double fees. But it's packed in these perspectives, it's packed in these books that they might get in the mail or they might get electronically, but they don't really see those fees. And so what the retirement risk report down is, it actually breaks down all the fees so you can see what your total fees are, and it breaks down your total income. And so you can see what you're actually earning and what you're paying in fees. And people are pretty surprised what that actually looks like when they see it in a written plan. And I have not seen anybody do something like this where a retiree actually gets an objective what's actually going on in their portfolio, and they can see where they want to be and where they are. It lays it out that simple. Where I want to be, where I am. And if you're on track, perfect. You don't need to do anything. But if you're not on track, then it gives you the opportunity to make that decision. And that's what we're talking about today, right? Out with the old and in with the new. If the old is not meeting where you want to be, a decision needs to be made.
Yeah, I agree, Daniel. That's great. And, the thing about this retirement risk report is that, so many times people get Monte Carlo analysis and whatnot, and various other kinds of things that typically are fact based upon fiction or fiction based upon fact, depending on how you're coming at it. That's not what this is. This is more like a contract. This is more mathematical than it is hope. And it makes a lot of sense to people. And since you brought that up, our listening audience, if you're interested in this retirement risk report, let's have a conversation to see if you qualify to be able to have that prepared for you. and if that will actually do you any good. Call us at 800-725-7616 and ask for the RRR conversation, the Retirement Risk Report conversation, so that you can know if you can retire in 2026, when in 2026 can you retire, if not 2026, what year, how much you need to retire, how much you want to retire. Those are two different things typically. How much you need to retire is typically what you need to sit on the couch watching TV. How much you want is to be able to do the traveling that you want to do and those other things that you've always dreamed about doing, the hobbies, the grandkids, whatever it may be, the second home. And we love to do this for you. Call us 800-725-7616 for your RRR conversation. 800-725-7616 for your RRR conversation. Listen to Financial Strategies with Andrew Daniel Agemy. Today's topic, Resolutions 2026. Out with the old, in with the new. Happy New Year. All right. Daniel, we don't have much time left in the show today. What are the things that we need to leave with our audience in the next bit of time here?
So folks out there, if you are close to retirement, you are 5 to 10 years away, you're in retirement. Let's make 2026 the best retirement year. Let's get set up for success. We have 4 action steps for 2026 to get you in the best place possible for retirement. And AAA, that first one, clean up and consolidate. You already talked about the estate plan. You talked about old 401ks, finding old accounts, combining them and getting them to start working for you. I know so many people who have all these 401ks all over the place. They get statements. They don't look at it. They don't know what's going on. And you know what the worst part is? They're not working very hard for the person.
The monies, exactly. And then we have like a new client of ours that actually called us up from the radio show. He's a listener, and he had inherited a 401k plan, or an IRA rather, that he was never told he had to take required minimum distributions. Yeah. And he was very upset about that, and rightly so. And then you got the people who have these inherited IRAs, who maybe it's $100,000. It's not a ton of money in the scheme of things. So they take dribs and drabs that they have to every year. But it's like that can be, there's strategies to employ that are better than just having this money spread all over the place. You know, one of our recent new clients, had money in probably 6 or 7 different financial institutions. And they realized that they wanted to consolidate it. And, just because they brought those over with Agemy Financial Strategies, Agemy Wealth Advisors, doesn't mean it's all in the same thing. They're still diversifying. The difference is they have an overseer to their diversification, as opposed to diversifying by companies. They're true diversifying by investment. So that's a very good point, Daniel. The clean up, consolidate. Another thing I want to say is people tend to squirrel money away. And, when you're in for retirement, well, that's a great thing. That's a great way to accumulate wealth. But in retirement, it's time to start consolidating these things so that they can actually work harder for you. We want your money being in a sweatshop, folks, not sitting on the beach sipping pina coladas. We want you to be on the beach sipping your favorite beverage, not your money.
Yeah, AAA, and that goes on to the second resolution, or the second step, and that would be shifting from speculation, switching from capital appreciation type mindset to an income first, or an organically or growing portfolio, right?
Yeah.
Getting paid.
Oh, beautiful.
Getting paid.
Right.
And I don't know anybody who, when they get hired at a workplace, says, I will take capital appreciation. There's some tech companies where they do this, but they're usually founders, not employees, right? To only get capital appreciation. That would be, you only have equity, and you hope that over time it goes up, because you can't live off of that. And that's what people try to do in retirement. And it's so funny to me that people try to do that. Whereas maybe you get a mixture where you get an income that you can live off of, and you get capital appreciation beside that, but you don't need capital appreciation. That's what we're talking about when we're talking about switching from a speculation mindset to an income first mindset, or a pay me. The third step, get aligned with terminology. Are you using the same terminology that the people investing your money is? And if you're investing the money, are the people you're getting advice from on how to manage that money using the same terminology? as we talked about earlier, right? Aggressive versus
Right.
conservative and speculator versus investor. Because the advice that you're getting, somebody's using one of those two definitions. But they're not telling you that's what they're using based upon the advice that they're giving you. And so you have to dive down and make smart, wise decisions.
Yeah.
Where is their bias? Is it the speculator or is it the investor? Is it aggressive or is it conservative? And does that align with your base? Exactly. And then get a second opinion, AAA. Second opinions, we have seen second opinions save lives. And second opinions, you don't want to be in a spot where your retirement gets wrecked, or it's not as good as it could have been, or it's more stressful than it needs to be because you didn't go spend a few minutes to get a second opinion.
Right. Yeah, second opinions. I believe in second opinions, and this will help people to alleviate the greatest fear of retirees is running out of money before they run out of life. Because usually by the time they realize they're going to run out of money before they run out of life, it's too late. It's too late to do anything. It's kind of like having stage 4 financial cancer, and all you can do is just the best you can do. But the sooner you recognize that financial cancer with a second opinion, the sooner you can make changes to align yourself with being an investor and to be able to make a resolution to change these old habits into new habits, better habits. So good stuff, Daniel. Good stuff. Second opinions are worth a lot. So you've been listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic has been Resolutions 2026, out with the old and with the new. Happy New Year. And we love to be able to give you this gift today of a book to the next 5 first-time callers called Smart Retirement. Different way of investing for retirement on a tax-free nature other than Roth IRAs. And we love to put this in your hand for free by calling us at 800-725-7616. For the next 5 first-time callers, 800-725-7616. Call now. And until next time, if you want your retirement to be stress-free, invest more for the I first rather than the G. Peace. Happy New Year.